US banks brace for Basel III Endgame, a game of capital rules and market reshuffling. In the realm of global banking capital rules, the final thrust of Basel III is upon us, promising to bring sweeping changes that will reverberate throughout the financial landscape. After 6 years of deliberation, US regulators are set to unveil their plans for implementing the last wave of bank capital rules. This move, known as the Basel III Endgame, carries significant implications for the banking industry worldwide, potentially increasing minimum capital requirements for banks, causing asset repricing, and reshaping trading practices. Challenges on the horizon. The impending implementation of Basel III has ignited debates among US bank chiefs. They express concerns that European banks may not adhere as strictly to the new rules, creating an uneven playing field. European regulators have estimated that the full adoption of Basel III could increase Tier 1 minimum required capital for EU banks by an average of 15%, with the impact on global systemically important banks in the EU reaching 24.7%. In the US, regulators project an increase of around 20% in minimum capital requirements for large banks, equivalent to an additional 200 basis points to their common equity Tier 1 capital. This move signals a more rigorous stance by the Federal Reserve, which will apply the rules to all US banks with assets of $100 billion or more, not just the major players. The complexity of Basel III. The complexity of the Basel III proposals is undeniable, with the expected release running potentially 1,000 pages long. After publication, a comment period of about 120 days will allow for further adjustments and fine-tuning. Both the EU and UK have approved the final part of Basel III, with finalization expected by December. US regulators aim to do the same around the same time, opening the door for possible changes and alterations during the sausage-making process, as Morgan Stanley CEO, James Gorman, puts it. Market impact and trading changes. Basel III's final rules will bring significant changes across various areas, including market risk, credit, and operational risks. Investment banking and capital markets operations will face substantial impacts, particularly in market risk, where the FRTB will introduce new requirements for managing risks related to market movements and trading losses. These changes will directly affect areas such as interest rates, stock markets, foreign exchange, and commodities prices. One crucial aspect of FRTB is its potential to influence trading operations in equities, debt products, securitization, and derivatives. Banks will have fewer freedoms to use their internal models, with the aim of addressing gaps in the current rules and better capturing risks during periods of stress. While some banks are concerned about specific products, such as yield curve spread options, becoming unviable under the proposed changes, others fear the repricing of assets could lead to products and services falling outside the regulated perimeter and into the hands of less regulated entities. Conclusion. The Basel III Endgame marks a pivotal moment in global banking regulations. As US regulators finalize their implementation plans, the impact of these rules will be far-reaching, potentially reshaping the competitive landscape and trading practices of financial institutions. Though challenges lie ahead in terms of regional differences and the complexity of the rules, banks will have ample time to adapt to the changes, with implementation expected to begin in January 2025 or beyond. As the industry gears up for this final thrust, all eyes will be on how the world's financial institutions navigate this critical phase in global banking history.